Welcome in, folks. Got a three-piece here today. Tom Lee, a day ago, I guess I can say, he went on CNBC, spoke about a whole host of subjects. He is extremely bullish, which probably doesn't come as a surprise because it's Mr. Tom Lee, everybody's favorite bull. But looking forward to reacting to that one, getting into that one there. Then we're going to get a little bearish here with SoFi's Liz Young. She says the economy's soft landing isn't looking as soft anymore. So we'll hear a bearish take. You know, I feel like after you hear Tom Lee, he's always so bullish that you kind of got to hear a bearish take after that just to kind of balance you out. And then I want to get into this one around Warren Buffett and kind of his positioning and things like that, okay? Hope you guys enjoyed today's video. Appreciate y'all joining me. All I need from you takes 5 seconds. Hit the like button, the thumbs up, and make sure you're subscribed here to the channel. That's it. That's all I need from you guys. Appreciate you. And let's go ahead and react to these.
Tom's good to see you. Welcome. You've heard the conversation. Why don't you weigh in? Is it time to get a little more bullish or not?
I think it's time to get bullish. Stocks really have been consolidating for the last couple of months, and I think the conversation you had is correct. You know, the data has not convinced hawks or doves which way inflation's breaking, and I think once we get a decisive data point, and potentially it's tomorrow, I think that $6 trillion of cash comes off the sidelines, and I think stocks break out of this range. And I mean, that's our bet that, you know, May ends up being a very strong month for stocks, even better than it's been already.
What's this rally about?
Wow.
Why don't you tell me in your own words what you think this is about? Why did we rebound so quickly? And why are we now on the doorstep of a new closing high for the S&P?
Well, I think that markets kind of had a very sort of simple framework in their head, which is as soon as inflation accelerates, the Fed switches from dove to hawk and tries to crush the economy. And I think Powell's been very clear in all of his recent statements that, look, inflation is not just this core headline number, and it's not just a services number. It's these three moving pieces: housing, auto insurance, and everything else. And they've been playing a waiting game. We're seeing that even in some of the recent articles, and Powell talked about it, and a lot of folks are talking about auto insurance. I think once that turns, and it possibly, because if you look at PPI, insurance actually rolled over pretty hard. I think it's going to make it clear to markets that it's not just a, hey, inflation is stubborn. It's really this, inflation is now normalizing. The economy's in good shape and rates are so restrictive, the Fed actually needs to cut rates. And that's actually quite good for stocks. I mean, look, if it's a pause, actually it's good for stocks. If it's a cut, I think it's even better.
I mean, I was looking at the sector activity today, Tom. I mentioned at the top of the program, you know, up volume was way outpacing down. Even earlier today, when it was hard to get much, if anything, going, there was only maybe one or two.
So let me push back against that. Let me take everybody in a little history lesson here for a moment. Let me show you guys the market back in 07 when they started to cut. And then we can see exactly where they actually peaked at prior to, obviously, the great financial crisis here. So let's go ahead and let's take a peek in depth here. So they started to cut rates in, you know, late 2007, if I recall. Let me Google it here. When did the Fed start cutting rates? If I recall, it was the back half of 2007. Let's go ahead. So September 2007. Yep, it was right on. September 2007 is when they start cutting. Now, the interesting thing, look when the market peaked. The market peaked October 2007, right? So this is why I have continually told you guys, I feel more unsafe in the market when the Fed actually starts cutting rates. That's just kind of how I feel. Everybody else is like feeling some level of comfort. You know, they can't wait till the Fed start cutting rates. I'm trying to hold it off as long as possible. The day the Fed starts cutting is the day I might have to consider hedging more, especially if the market's running hot and hitting new all-time highs and new all-time highs into that cut, essentially, okay? Because then the Fed kept cutting and kept cutting and kept cutting, and it never mattered, right? The economy had already gotten hit way too hard, and obviously we went down. So, you know, if the Fed doesn't cut at all this year, I don't mind. Like, literally, like, if the first cut doesn't come till 2025, okay. Because I'm worried that once the Fed starts cutting, you know, it's going to mean there's bad things coming likely in the economy. and then the Fed's going to keep cutting, and it might be potentially a bit of a situation. Do I think it's going to be a 50% drawdown for the market? No, I wouldn't go that far, right? But do I think we can definitely get hit pretty hard while the Fed's potentially cutting rates, when everybody thinks when the Fed's cutting we're going to be skyrocketing? I think that's a potential. So yeah, my opinion is I'm in no rush for cuts. And you know, anybody that thinks when the Fed starts cutting, it's just guaranteed we're going to skyrocket, it doesn't work like that.
That we're green now. Almost everything is green. You know, tech is having a great session here. That is now, you know, leading the way. A lot of the names there are green. What are we to make of this new closing high for NASDAQ, especially after some of the rollover that we saw, you know, in the month of April in those names?
I think it's really good news. I think a lot of folks thought this was a ninth inning market expansion, or, you know, an extended rally. But I think the revival of meme stocks and the fact that there's still a huge amount of cash that's been accumulating on the sidelines in the last couple of weeks shows you, look, I think there's still a lot of legs to this rally. That's why I think May could not only be strong, but of course, as you know, stocks could do very well into year end.
Liz, what do you think?
I still think that we'll struggle at all-time highs. And a couple weeks ago, after the Fed meeting, I got near-term bullish because there was nothing that he came out with and scared us with. And actually, he seemed pretty confident that they were on the right.
We're going to get Liz Young times 2 here in just a moment.
And the market interpreted that in a positive way. Now that we're knocking up against new highs with really no positive data behind it, maybe no big negative data, but it's really just been the removal of risks.
Isn't that all that matters? Get those risks out of the way?
To have more multiple expansion at rates that are the same level?
But they're not the same level. They've come down like 25 basis points since the Fed chair spoke at the meeting.
But the Fed funds rate hasn't come down. So the intention to restrict capital activity hasn't come down. And in fact, it stayed where it was longer than we expected it to. So I think we would need incrementally better fundamental news to take us meaningfully higher and have it be durable. I don't doubt that Tom might be right, that we would blow through all-time highs and have some more room. I could be wrong about that. I don't know that it'll last very long unless we get better news and things actually look fundamentally better.
Yeah, I think it's going to be about this inflation print tomorrow, whether or not the market tends to rally on from here. I think earnings have been driving the ship for the most part. You've had, 80% of companies outpace expectations, up 8%, which is, been good when you look at the 10-year average. But to Liz's point, we need to see some support from economic data, whether or not this rally is sustainable. I think the cooling labor market data helped out a bit, and earnings coming through to support that. But ultimately, it's going to be sort of like, show me what you got with the CPI print tomorrow. Like, is this consistently sticky inflation, or is this just an...
If anybody's with JP Morgan Private Bank, reach out to me, via Instagram, or if you're in the private stock group, reach out to me in Discord if you're a customer of the private bank. They'd reached out to me recently. They're trying to get me, to be a customer of the private bank. And I kind of asked them for some more information. They gave me and whatnot. And I don't know, just if anybody's out there watching this right now, and you got to be very rich if you are watching this and you're a private bank customer, just let me know what your experience has been. Right now, I've been like a private client or whatever for probably 5, 6, 7 years now. But I'm curious about the private bank. So let me know, reach out if you've ever used them or
those last 3 months.
Tom, why don't you justify the multiple that the market's trading at? If, look, you could say, well, earnings were good, earnings were better, but a lot of the earnings came from the very top.
I just didn't see a reason why I would go to the private bank side. There was nothing kind of in the information they gave me, at least I was like, oh, I should get private bank.
Right. The bulk of the earnings growth came from mega cap. So that's a little misleading. Why do you justify the multiple here? Liz has trouble with it. Why does it make sense to you?
Well, there's a couple of points to clarify. Number one, the median market multiple is 16 times. So is that demanding when 10-year yields at 4.5% since 1928? Actually, the median multiple should be closer to 20 times for the S&P. In terms of earnings dispersion, or the number of companies producing double-digit earnings growth, it actually hit 47%. It's the highest in over 3 years, which means earnings growth is actually accelerating, and that's with 3 sectors with negative 20% growth: energy, materials, and healthcare. And in terms of price action, I think investors need to be mindful when an index or a stock is bumping up against new highs. and then you layer in a dovish Fed, that's not a bearish setup. That would be extremely bullish. It's going to pull a lot of money off the sidelines. So to me, I think the earnings backdrop's been very good. I think people have been misled by oil rising, thinking that's going to cause another wave of inflation, and it's not. And of course, I think the VIX is telling us, conditions are more risk on than risk off.
So that's the second time now Tom Lee's mentioned about this whole money's going to come off the sideline into the market, right? So, okay. So if the Fed starts lowering rates and there's FOMO in the market, absolutely some money will come off the sidelines. Off of that, $6.4 trillion or whatever is in money market funds, right, and make its way over the market. There's no doubt about that. But where I'd push back against Tom Lee is, a lot of these bulls, they make it sound like all 6 trillion's coming over and it's just going to be this windfall of crazy amount of money coming over. No, okay. Best case scenario, 500 billion to maybe $1 trillion comes off the sideline and into the market. But in order for that to happen, you're going to need rates not just be a little lower from here. You're going to need them to go massively lower, where people start to say, I got to be in the market because I'm basically getting no return on treasuries, getting no return on savings accounts, anything like that. That's what's going to have to happen here. And so whenever the Fed starts lowering, they're likely going to lower by a quarter point, 25 basis points. So no one's going to make any big decisions out of money market funds by 25 basis points. They're going to need to go down by at least probably 150 to 200 basis points, so 1.5% to 2%, to make people actually say, you know what? Let me get money out of the savings account. Let me get money out of treasuries. Let me go ahead and put this into the market. And if you have like FOMO in the market in general at that time, people see a lot of other people making money. There's no doubt you could get a kind of an insane kind of blow off top situation. But to act like 5 trillion's coming out of there, 6 trillion, no. Most 500 billion to $1 trillion.
What's this meme stock resurgence of this mania, part 2? Maybe it's part 3 at this point. I can't even remember. What does that tell us?
I actually think it's healthy. I think it highlights a segment of retail investors that are learning about the stock market. Now,
stop it, Tom Lee. We know factually this has very little to do with retail. We know it has a lot to do with big money. Stop it, Tom Lee. Come on.
GameStop.
You're Mr. Data. Look at the data.
A huge buy. I don't have a view on it, nor do I have a view on AMC, but I actually think speculation's healthy, and they're not employing a lot of leverage. So to me, it's just a sign that stocks actually have a revival potentially coming.
What do you guys make of this? Tom says it's good, AJ. What do you say?
No, I think what we're focused on is more quality, and we do like small caps here, but we like companies with more free cash flow. I can't speak on a specific company in particular.
That was a good pivot.
Like that? I learned it from Liz, so I learned it from the best.
Pro Bowl punter. AJ Oden, ladies and gentlemen. But I mean, what it signals, forget about the stock. I don't care about the stocks. I'll care about the signal that here we are in a moment of time again where a photo on social media sends off this frenzy in a pocket of the market that last time this happened made us a little bit uneasy about what the overall...
This is a problem. Is you got these Wall Streeters that really set up folks, the gamblers, into this GameStop and AMC situation, then just absolutely wrecked them, right? This is all of a sudden retail wants to get in. Oh, yeah, what? AMC's hot again? GME's hot again? Oh, let me get in, right? A few days ago, all of a sudden, everybody's talking about CNBC. They're buying it at $8, $9, $10, $11, and you just lost over 50% of your value in a matter of 48 hours or so, right? That's how it works out. The whole, and I spoke about this in the main channel a couple days ago. I said the whole situation doesn't make sense in regards to this GameStop AMC. It made sense in 2021. You had everybody forced to be home. A lot of people were looking to get in some action, right? That represented the action. People hadn't been burned yet by this situation, and people were flush with cash, right? But they hadn't been hit by inflation. They had stimulus money, stimulus checks, all this stuff, right? PPP loans, and so people threw it into the the GameStops and the AMCs and these sorts of stocks, and it went on for several months, really, right? And it blew up into this big thing. Yeah, I knew this wasn't going to last for a long time this time, right? I knew it. Because People don't have money like that. People have been sliced and diced by inflation for 3 years. They don't have money to just say, "Oh yeah, let me go put 50,000 in AMC. Let me go put 20,000 in GameStop." No, but man, it has very little to do with retail. And the only retail I really got in just got absolutely obliterated in that situation.
Message was. So what do you glean from that?
I would say
Over speculate. What you tell me.
Well, I mean, what I would say is that you're always going to have pockets of speculation and,
That's true.
Money
100%.
chasing various investments. But we always try to advise our clients to really kind of keep looking at the long-term investment. When I think
This man's from JP Morgan Private Bank. He's dealing with people that actually have real money. Big money.
I think
10
at the end of the
million
day,
plus
it is a
net worth.
positive thing that we're getting more participants in markets, and that's a good thing. When we tell our clients, we like to, they're going to pick names that we're not always going to agree with, but it's important to make sure that your risk appetite is adjusted appropriately. So I think it's a good thing because you're seeing more market participants. That's always positive for markets.
I knew you had something in there. I just had to work on
pull a little bit more.
I knew you had something in there. That was good.
Look, I think it's.
You say it's FOMO. You said
I do think it's a little
fear
FOMO.
of missing out.
But here's why I think it's FOMO, because I think I'm not alone in looking at this recent run up in the market and feeling like, are we getting a little exhausted with it? So investors are now looking for, where else can I find this much upside? And we're running out of ideas because there has been so much upside in certain places, and the broadening out trade has provided us with more ideas. So we're still looking for that upside. So the positive about that is that risk appetite is still alive. Investors still want to put money in equities. They're not taking their ball and running home. That is a good thing because we want to see buying activity in the market. But the same risks still exist as they did the first time this happened, or maybe the second time this happened, in the sense that, up 300% in 2 trading days, that's a lot of volatility that I think most investors might not be ready for the timing of, and you want to be careful not to expose yourself too much to something. I don't think anybody really believes that there's a huge fundamental reason that meme stocks have started to take off again since last Friday.
No, I think that's reasonable. I think that's a reasonable.
I think we all understand
Liz.
that this is trading risk, but to make sure that when you're taking trading risk, it could all disappear just as quickly as it was given.
All right, so Tom Lee, this broadening story. Remember, you sat with us at the beginning of the year, said small caps are going to go up 50%.
Wow.
The Russell's not even up 3% year to date. And rates have held it back. I think we can agree on that. As rates come down, the Russell goes up. It's leading on the week. It's had a nice month. But what about that call, and where does it go from here?
Good question.
I think the fundamental backdrop for the Russell 2000 to outperform is actually better today than it was at the start of the year. We have a lot more earnings visibility. The median earnings growth of the Russell 2000 stock is actually about 600 basis points higher than the S&P. So you're getting better earnings growth. And the PE multiple discounts 4 turns on a median. Actually, it's closer to 6 turns of a discount. So if we're thinking about risk reward, Russell 2000 is going to be a much better place. But as you point out, it really depends on the market being convinced the Fed is dovish. I think once the number of cuts starts to stabilize, that's expected, or even increases, that's really bullish for small caps. And of course, I think it brings money off the sidelines. So I still think it's a 50% move.
What about, you still think it's a 50% move, standing by that call. What about the broadening story in general? What we've, 1 month, the utilities up 11%. We're talking about utilities now, Tom, as an AI play. That's where we've come to. Staples are up 5%. We're rallying towards new highs with defensive type things taking us there. Is there a message in that I need to be aware of?
Yeah, I think the utilities move checks a couple of boxes. It's rate sensitive, so it could be the market telling us the 10-year could be even lower. It could be defensive, as you're pointing out, which wouldn't be good. Or it's AI, as you point out, which is actually a fact. We know there's a huge power shortage. I still think this is all that indecisive data, but it's actually broadening. And again, to me, at a time when the S&P is near an all-time high, I think investors should really be half full and looking at the totality of this information.
And lastly, before I let you go, we're at session highs, by the way, Tom, as I ask you this last question. And we're looking at the NASDAQ currently at a new record close. So tell me about mega cap. Are you still as big a fan of these stocks as you were?
Yes. I think that anyone who owns mega caps should really put on a 3-year horizon and understand these story arcs behind all these companies. I mean, they're growing prodigiously at a time when GDP growth is 1.6%. These aren't going to lose steam in the next couple of quarters. And whether it's generative AI or cloud consumption or social media or millennials, these are long-tail stories. And I think that's why they're going to work for a long time. And these are the best companies basically globally. So they're very, very scarce.
All right. Tom, we'll leave it there. Everybody, I appreciate that. I enjoyed that as we watch this market at record highs. AJ Oden,
this is
we'll talk
why
to you soon. Liz Young and Tom Lee.
This is why it's really difficult.
By the way, Tom Lee's going to be part of CNBC's financial advisors.
Oh, this is why it's really difficult to get this bull market to end. Because do you guys know the famous saying in the stock market? The famous saying, bull markets are born on pessimism, grow on skepticism, and die on euphoria. And when you look out there, right, and you know, that's a great thing about having this reaction channel. I react to so many different folks all the time, all these different Wall Streeters and their opinions and whatnot, right? I think we're still in a skepticism period right now, right? You have the bulls like the Tom Lees, and then you have these Liz Youngs and folks that are kind of more like, you know, I'm not that excited about the market. You know, I think there's downward, blah, blah, blah. And they have their reasons for why and so, you know, you got to worry a lot more when it just seems like everybody is bullish, right? And everybody's kind of in this euphoric state. And when everybody's kind of on Tom Lee's side, that's when you got to be like, oh boy, you know, we might be setting up for something. And if we go back to the end of 2020 and into the, you know, first half of 2021, I think we were definitely in that euphoric state where it just seemed like everybody had turned bullish and it was hard to find anybody that was bearish then at that particular time, right? Right now, you can still find a lot of bears, or a lot of people kind of skeptical of where the market's headed, what's going on here, which almost gives you more confidence that this bull run might not be over anytime soon. We got still a lot of people to pull over to the really bullish side that say, you know what, I got to get in these stocks. I got to buy Meta. I got to buy Nvidia. I got to buy Apple. I got to buy, you know, whatever. And so I got to buy small caps. I got to get in the Russell. You know, we're not quite there yet. Let's hear a little more from Liz Young here.
AJ Oden, an investment strategist with JP Morgan's Private Bank. You see both are here at Post 9. Welcome back, everybody. All right, Liz. I mean, here we are, like 9-10 points away from a new high. But I read here that you say if we take out all-time highs, a new pullback begins. I thought it would confirm the fact that we've been able to rally back so sharply and set us up for what's ahead.
So let me clarify. When we hit 5,200 and crossed over, I felt like momentum would continue in that direction. Momentum is still very much intact. We're above the 50-day, the 100-day, the 200-day. We've taken out all the technical retracement levels. We're at about 86% retracement. So we are right on the cusp of hitting that all-time high. The intraday high, I think, is a little bit higher, about 52.63. So to take that out, then I think we struggle there for a while. I don't see another leg beyond that that's meaningful unless we get some kind of really cool CPI tomorrow and cuts get pulled forward.
Is that what this is about right now? You know, again, today's initial read, people said, oh my gosh, it's hotter than expected. But then you saw the revisions lower. And even the Fed chair who was speaking live today over in Europe wouldn't call it hot. He called it mixed.
Yeah, well, I mean, as a surprise to absolutely no one, Powell said rates are going to stay higher for longer. The other thing that he did say today was that basically they don't see GDP staying below trend anymore. So maybe seeing growth getting a little bit stronger. If CPI stays exactly where it is for the second quarter and GDP actually heats up, so we were at 1.6 for the first quarter, if it gets hotter again, there's no reason for them to cut. And the market has been okay with that so far. So right now, I don't think there's also any reason for the market to pull back in a meaningful fashion. But if we surpass those all-time highs without really any good news to take us into the next leg upward, and without an earnings season that's going to start anew yet, there's not that much support fundamentally to take it, let's say, another 5 or 10% beyond that in this moment.
Let's debate that. AJ, what do you think?
Well, I think I'd have to agree with Liz to a certain extent just because of the fact I think we're getting away from the double dutch of how many cuts we're going to have. And the market just believes the next move is a cut. And so we're in a better place than we were last year.
The market's correct, isn't it? The market believes that the next move is a cut.
Yes. And I believe that's where we're headed from here. And so as much as maybe, you know, whether or not we need to have a cut, that we could debate on. But I think as long as we still believe the next move is a cut is what's important right now.
But I mean, to Liz's point, the economy, let's say, okay, forget 1.6%. Let's say the economy is stronger than that. Aren't we talking about the definition of a soft landing, that the CPI is, let's say the CPI tomorrow comes in how we'd like it to come in, and growth, picks up a little bit. Isn't that what a soft landing looks like?
In a sense, I think that's what we all want. We want CPI to come in, right in expectations, because then it tells us that first quarter of this year was a blip on the radar. And so as long as we're making it towards that 2% mark, yeah, if we don't get a cut this year and we get it next year, as long as we're still heading in the direction and the next move isn't a hike, I think that's what's most important. And that is a soft landing.
But I'm going like even the Fed chair.
No. Economics 101, push back against this. Okay, so, that thought process of like, well, as long as we're getting closer there, what if we still haven't got rate cuts and it's a year from now, right? What if we're still high 2s, low 3s, and the Fed's like, man, we still can't quite cut because, inflation is still way above our 2% number. The longer you push this out and push this out and push it out, right, the more the strangulation on the economy, right, the more the Fed and their interest rates can kind of slowly but surely just kind of devastate things in regards to the economy, right? We're already, are obviously seeing several companies showing us signs that the strangulation by the Federal Reserve has started, right? You can see it clear as day in a lot of these big company numbers, right? Today was a perfect example. Look at Under Armour's numbers, absolutely trash. Now, Under Armour's not a high-quality company anyways, but you look at those numbers, and they're way worse than people expected, and the guidance was horrible. And then you look at somebody like a Walmart. Walmart's doing better than anybody expected. That's not good. When Walmart's doing better than everybody expected, not good. Walmart stock was going up because they said they're attracting more higher income earners. Not good. That's not, there's no bullish scenario in that, okay? When Walmart's business is going like this, it usually means that people are trading down and they're being forced to shop at Walmart, right? No, I don't think anybody goes out of their way and says, I can't wait to go to Walmart, it's so exciting. No. So that's the issue here, okay? We got to be honest, though. The longer the Fed stays high, the more risk it has to the overall economy.
Days like he says, well, and a year ago, and core was 7 point whatever, and now it's 2.7. They're sort of dropping all the messages that they want to cut. They're just waiting, and they just don't feel the need to do it now, and that's great, because why should they do it now?
Well, it's good in the sense that this pause period is usually pretty good for the market. So nobody should really be clamoring for cuts, because that's typically what gives the market a problem. There is no reason for them to do it now. And absolutely, we've made progress. Coming down from 7% or coming down from 9% CPI is definitely progress. But in my book, a soft landing includes getting back to target, or at least getting much closer to target. And their particular metric is not the one that makes the most headlines. We talk about CPI more often, which still, even this week, is expected to come in at 3.6% for core, which is just too high. And it is taking a bite. We're seeing consumers change their preferences. We're seeing trading down again. And we've seen this before in this cycle, and consumers have come back. But we're seeing it again, and now at a time when you also see delinquencies ticking up. So we're starting to teeter on that edge of soft landing not looking quite as soft anymore if we continue at this point.
Fair. Fair. I think you're getting a lot more data points now at this point in time that point to, a soft landing, maybe not. I think if you went back 3 months ago, 6 months ago, I think the picture for a soft landing looked better, because it looked like inflation. If we went back 6 months ago, let's say, for instance, I think there was a thought process that right now we'd be in the 2s for CPI. We're not. We're still in the 3s, right? 3.4, 3.5. We've been here recently. So that is a problem in itself, because once again, it means rates higher for longer, right? And then additionally, I think if anything, there was a lot of good feelings about earnings 3 months ago or 6 months ago. And I think some of that feeling has started to go away with, McDonald's earnings, Starbucks earnings, companies like Under Armour, companies like Nike, Whirlpool. Just a lot of these companies' numbers have been bad. UPS, FedEx, these are big dogs, super famous companies. that have had some troubling numbers. And then you tack on Meta's guidance a little weaker than expected, Amazon's guidance a little weaker than expected. And I think all that kind of makes people say, oh boy, you at least got to start paying attention to, could we have real problems in the economy 6 months from now, 12 months from now, right? And when I say real problems, I'm talking about unemployment cycle or things likely to get better. And I think that's the moment where I don't think it's a crystal clear either way. I don't, if we look out, let's say 9 months from now, right, in between that 6 and 12, 9 months from now, is the economy better or worse? I don't think it's clear right now, because okay, it could get better. Let's say real wages, pick up. Let's say energy stays low. Let's say inflation finally gets down to those twos. Meanwhile, wages are going up 4%. Okay, we can see how things could get there, but there's also a different scenario where maybe unemployment ticks up significantly over this 9 months, right? Next 9 months, and then the economy starts getting hit, and then the Fed is starting to cut, but then they start having to cut rapidly, and it's kind of like panic mode for the Fed, right? I mean, things can change rapidly in 6 to 12 month span. So I don't think either side is clear right now, and I think for either side to just act like the other side doesn't exist, the soft landing or the hard landing, I think is a mistake. Warren Buffett.
How did Mr. Buffett strike you? It was a weekend of some sentimentality, maybe some melody.
This is a little bit of an old clip. It's from 10 days ago, which is like ancient, because usually I react to stuff the same day or a day after. But this one I wanted to react to because I thought it was an important subject.
As Charlie Munger, his longtime compatriot, was remembered. How did Mr. Buffett strike you?
Well, he has been such a generous and brilliant and wise man in my life that there's hardly anything he can do that disappoints me. He's 93 years old. He just had his closest friend and his closest business confidant pass, and he's feeling the effects of that. And Charlie, they started the meeting out with a bunch of Charlie witticisms of the past years, and you couldn't help but be emotional about it. It's really the end of an era.
It was clear in some of the sort of subtext that Greg Abel is.
I will say, and I didn't watch the whole meeting, but I watched a good amount of it, and I will say, Buffett did seem a little sad. I was kind of a little sad hearing him be a little sad, and yeah, he just didn't quite have that bit of like optimistic happiness. Like you can almost tell in somebody's voice, when they're just, something has them down. And that's just kind of how I felt kind of watching that. I was like, dang, man, like it seems like he's actually, and I understand because I don't think there's anybody on this earth that he could really talk to, about subjects, business, money, those sorts of things outside of really Charlie Munger. I don't think, for him to speak to anybody else, it's probably not the same. And so, it's right there with probably losing, a wife or a husband or something like that, right? It's not easy.
Assuming a more important role internally, he's the designated successor. Did you feel that way?
Mm-hmm. Oh, yeah. He will be the CEO of Berkshire Hathaway, the primary asset allocator among buying whole companies versus putting more toward stocks, et cetera, which was kind of a surprise to us. We thought the last 10 years or so would be a process of turning more of the reins in company selection to Todd Combs and Ted Weschler, and that explains why they haven't been given a more prominent position at the annual meeting. We wondered about that the last 3 or 4 years, and we got that question answered for us. But it will be a different company. It's a wonderful, large conglomerate that is closely tied to the United States economy. And if you want a wonderful company closely tied to the United States economy, it would be a good investment for you.
Yeah. They should include Todd and Ted a lot more, in my opinion, over the next couple of years in that meeting. I think it would make a lot of people a lot more confident if those guys could field some questions as well.
10 years.
And of course, we should not. even suggest that Mr. Buffett is anywhere close to finished yet. He is an amazing leader, amazing stamina, and of course is still fully in charge here. So let's talk about their big cash pile, $180-some billion, heading to $200 billion. What should they do with it? There is some discussion. Would you, as a shareholder, like to see them pay a dividend, or would you like to see them make a big acquisition, or would you like to see them buy back shares?
Good question.
We have no interest in the dividend. It's fine to have them buy back shares, but you always have to think about Berkshire Hathaway, do as I do, not as I say. Because Warren Buffett is a super nice guy, and he has absolutely no interest in offending people. But if you look at what he's doing, he is as bearish as he ever gets. I read right between the lines, right from the beginning at the meeting on Saturday. I was there sitting in the audience, and I thought, okay, huge cash position, trimmed his Apple position. He's nibbling on something below the surface they haven't announced yet. But basically, he is waiting until the next 40% decline in the stock market to apply massive amounts of capital at bargain prices in things that are large enough to be meaningful to this company at the size it is now.
So I got to push back against Buffett, because here's what Buffett would tell Buffett. Buffett would say, okay, one, you don't know when the market's going to decline. You don't know when that 40% whatever decline, 40, 50, 30%, whatever it is, right? You don't know when that's going to happen. Secondly, between now and then, the market could climb 30, 40, 50%, right? Buffett's been sitting on, he's been sitting on record amounts of cash for years. This isn't something new. Even prior to Rona, they were sitting on ridiculous amounts of cash. And meanwhile, the stock market's gone higher and higher and higher. Stocks have doubled, tripled, quadrupled since that particular time period, right? And, Berkshire's cash pile's just built and built and built. So then all of a sudden you're like, dang, I need like a 50% decline in the stock market. I need 60%, 70%, 80% just to, get down to the pricing that it used to be when you were started building this big cash pile. So, but I don't, who's going to push back against Buffett? If he wants to build his cash pile bigger, is Greg Abel going to check him? No. Todd and Ted going to check him? No. There's only one man that probably could have, and he's not here, right?
You just used the phrase, this is as bearish, I believe you said, as I have ever seen him. Is that really the right characterization, or is it rather that he thinks the market is too highly priced for him to go in a big way and put fresh capital to work? In other words, is it so much a bearish call as it is a rejection of the idea that this is an opportunistic time to invest?
Tyler, you have asked a great question. So I'm going to answer this in kind of an odd way. In 1969, he pivoted from being primarily a quantitative Ben Graham value guy to being more of a Charlie Munger qualitative guy, right? Get a reasonable price on a great company. And he said back in 67, 68, 69 that the quantitative ideas that he used to like to buy were combed and recombed. That was his letter to partners. And this last year, he said that the kind of things that we would like to do have been endlessly picked over. So that is code for, we think the market's expensive. We're not in any hurry. We're going to wait. And remember, he's talked constantly for 10 to 15 years that the bigger Berkshire gets, the more it limits their opportunities.
Right.
That's true. Really, to have very large opportunities for large deployments of that $200 billion, you've got to have the entire market get into very difficult circumstances.
So, I got some more thoughts I want to share on Buffett here. But before I do that, let me let you guys know, got a brand new workshop for you guys. Pin comment down there, recorded last week's 32-minute video. Goes into 7 steps to 7 figures plus, the action plan on how you can actually achieve that, how you can scale faster, some growth hacks I share in that video. So pin comment down there. Make sure you get that before today's video is over, okay? Now, some finalized thoughts here. Part of me feels like at this stage, I think Buffett's actually holding Berkshire back. And I don't think you could have said that 10 years ago or 20 years ago, or certainly not 30 or 40 years ago, right? But nowadays, I actually do feel like Buffett is unfortunately holding the company back. And the reason being is because he just refuses to acknowledge these, massive companies that are the companies that are going to be insanely successful, not only today, but tomorrow and the next year and the next year and the next year. The Amazons, the Teslas, right? The Metas, the Googles. He just refuses to, obviously the chip makers, the AMDs and the NVIDIAs and these sorts of companies, right? And the other semiconductor companies, he just refuses to, even be interested in those companies. Those are companies he could easily build positions in the billions of dollars or tens of billions of dollars and not move the stock substantially at all, right? And those companies are just going to become more and more powerful. And those are going to be the companies that are going to have the $5 trillion, $10 trillion market caps on them, 10 years from now. And he's just, all of those type of opportunities are just completely missed by him, right? And any AI companies, right? Is he going to buy a Palantir? Highly unlikely. But these are sorts of like real substantial big opportunities. And he can't, and they're the type of stocks he could actually build positions that are in the billions or tens of billions of dollars, but he just can't do it because, he's not able to kind of wrap his head around these sorts of opportunities in these companies. And he's been very open and honest about that. So it's a weird situation because I do feel like when Buffett, steps down or, passes, whatever the situation is, right? I do feel like Berkshire will command less of a valuation in terms of a P ratio because I feel like there's like a Buffett P ratio. But I actually think there's a real potential that the investment side might end up being run better because, other folks might actually understand some of these big tech companies and see those as opportunities, right? Because this is not the 2000 tech bubble where companies where it was like, gambling on cryptos or something. And it's like, I don't know, this might be the big thing someday. These are proven business models now by proven CEOs, proven balance sheets, proven income statements, right? They're not just magically going to disappear. It's not how this works at all. And these businesses are as stable as any other business you would invest in, but maybe even more stable. And these business models are honestly better. They're better. These Intuits, the Adobes, Google's, Metas, all these sorts of companies, their business models are better than anything that's been created before them. The way the whole thought processes, the ecosystem around these businesses are so much more intelligent than businesses that were built 30, 40, 50, 60 years ago. I mean, it's like night and day. And these business models are far more stable because a lot of these business models have recurring revenue streams, right? Recurring business model. I mean, it's just, and so, yeah. That's kind of where I'll leave it with Buffett. I think Buffett's, and that happens to everybody, though. You got to understand that happens to everybody. Michael Jordan wasn't the same at playing basketball when he was with the Wizards than when he was with the Bulls, right? He was a shadow of himself. At some point in time, everybody, you reach an age and you're just not as good as you used to be at that particular thing, right? And it happens to everybody. Tom Brady in his last season playing football wasn't the same as Tom Brady 10 years prior to that or 20 years prior to that, right? As time ticks on, you reach a certain point where you go over your prime, right? And when you really look at your investing prime, in my personal opinion, your investing prime is 40 years old to 70 years old if you start it really young, right? So I'm not even in my investing prime yet. I'm 34 right now, right? I think my investing prime, 40 to 70. That's kind of the perfect age where you've got a lot of experience. You're still got a lot of energy. You still are young enough to kind of see the future and kind of also know the past and, what's a fad versus what's a sustainable trend for the long term, right? But, I mean, when you're starting to talk about your 90s, it's a different ballgame. I mean, the world you were brought into in your 20s and 30s, right, in your teen years, and the world's just so much different. The way everything works is so much different. I mean, it's a night and day difference, right? I mean, imagine being a teenager when Buffett was a teenager. When was he a teenager? In the 40s? In the 1940s? 1950s? He's probably in college in the 50s probably, right? I mean, it's a very different world in the 1950s in the United States of America versus nowadays, right? And so it just happens to everybody. Right? It'll happen to me someday. It'll happen to everybody. I was running the other day. I pulled my damn hamstring. Like, you know, I'm not the same as I was 15 years ago. I couldn't even imagine pulling my hamstring 15 years ago. You flip my flapjacks? Never going to happen. I did it now, right? I'm not as athletic as I once was, right? And so, yeah, that's life. And so, anyways, that's a moral of that story. Appreciate y'all joining me as always. Much love, folks. Make sure you get my new workshop. That's going to be pinned comment for you. It should help you out immensely on scaling to your first 7 figures in the market, and some growth hacks in that video that should help level you up. It's absolutely free to join in there. Make sure you get access to that. It's very valuable. Much love and have a great day.